January 15th, 2026. Silver is trading around $90 an ounce. Gold is hovering near 4,600. And less than a day ago, the United States Mint did something you're not supposed to see in a functioning market. If you went to their site looking for silver eagles or the big silver collector pieces, the photos were still there, the descriptions were still there. But the only thing that actually matters, the button that lets you turn dollars into metal, was gone or stamped temporarily unavailable. No press conference, no emergency briefing, just a line to distributors about extreme volatility and a promise to review pricing. If you write that off as a website hiccup, you are volunteering to stand at the back of the line. Because when a sovereign mint steps away from selling silver at the very moment prices are breaking records, that is not background noise. That is the first crack in a market that has been running on more paper, promises than metal for years. At the top, this is a stress test of the entire pricing system, from New York to London to Shanghai, a test of whether the number on the screen still means anything when people ask for delivery. At your level, it is a warning that your app can still flash $90 an ounce while the real-world cost of actual coins and bars behaves like $130 or more. What you just saw is stage one of a pattern that metals markets follow when they hit their limits. To see why that crack matters, you need the simple puzzle underneath it. For years, major banks and research houses treated silver like a dull corner of the market. But their own reports now admit that demand has been beating new supply by hundreds of millions of ounces. UBS, Fitch, and others talk about a combined shortfall near 300 million ounces across 2025 and 2026. And that kind of gap between what comes out of the ground and what the world wants, a retreat like the mints, where an official seller can no longer name a firm price on many silver products, is not just a fussy bureaucracy scared of big moves on a chart. It is the visible edge of a market structure that is grinding into the physical limits of how much metal is really available. To make sense of what follows, I use a simple 5-stage pattern. Stage 1 is the sovereign signal, when mints and official channels are the first to flinch. Stage 2 is the vault drain, when registered exchange inventories and other big pools of metal are quietly drawn down to plug the deficit. Stage 3 is the paper divorce, when the quoted price on screens drifts away from what people actually have to pay to get real bars and coins. Stage 4 is the policy hammer, when margin rules and trading terms are changed to slow the panic instead of fixing the shortage. Stage 5 is the endgame, when the system decides who absorbs the loss, whether that is holders of paper claims, savers through inflation, or confidence in the market itself. Keep that pattern in the back of your mind, because as we move forward, we are going to stay with Stage 1, the sovereign signal, and watch how the usual idea of fair value starts to slip once the official channels step back. Stage 2 is the vault drain, the moment when backup supply quietly turns into the main supply. For years, the gap between what mines produce and what the world uses has been filled by taking bars out of the big pools. COMEX registered stocks in New York, London vaults, and metal that was supposed to sit in ETFs and custodial accounts for a rainy day. Now the data is blunt. COMEX registered silver, the category that can actually be delivered, is down more than 70% from where it stood in 2020. Traders talk about tens of millions of ounces standing for nearby delivery in single days where 7-figure amounts walk out of the warehouse. Over several years, that kind of draw does not just nibble at the edges. It empties out the equivalent of many months of global mine supply. At that point, the question for an exchange is no longer whether there is some silver left in the building, it is whether there is enough that you can promise smooth delivery to everybody who might ask for it. Once that confidence starts to wobble, you change the rules, you nudge clients toward cash settlement, and you hope more people roll their contracts instead of calling for bars. That is Stage 2, the vault drain. The machine still runs, but more and more of it depends on nobody really testing how empty the cupboard is. To see how fragile that is, picture 1,000 ounces of silver stacked in a professional vault. Real bars with serial numbers, the kind you could walk in and touch. In a clean world, that would mean 1,000 ounces of claims, 1 bar, 1 owner. In the real bullion system, those same bars support layers of promises. A bank holds them in an unallocated account for a large client. It leases some of that metal out. It writes forwards and swaps against it. An ETF shows the same pool as its backing. Other derivatives point to the same pile. And on paper, that 1,000 ounces becomes 10,000 ounces of claims. Most of the time, that looks efficient, not dangerous, because almost nobody asks for delivery. People are happy to roll futures, to flip ETF units, to sit in pooled accounts that are really IOUs with a glossy label. The illusion holds as long as redemptions are a drizzle, not a flood. Now imagine a real squeeze. Prices jump, nerves fray, and a small slice of those paper holders finally say, I do not want a promise, I want bars. If even 10% of the claims try to stand for delivery, that is the entire 1,000 ounces. The bank cannot satisfy everyone. Some people are pushed into cash instead of metal. Some are delayed. Some are told their allocation is temporarily constrained and invited to roll again. On your phone, it still looks like there is endless silver at the tap of a button. Inside the vault, there is a fixed stack of bars that has been sliced, pledged, and reused so many times that a modest change in behavior can snap the structure. When you hear words like unallocated, pooled, or cash settled, that is what you are really looking at. A game of musical chairs where far more people think they have a seat than there are chairs. There's one more idea you need before we move on: backwardation. In most commodity markets, later delivery costs more than getting the stuff now. If you buy oil or wheat for 6 months from today, you usually pay above the spot price because someone has to store it, insure it, and wait. In silver today, the real world is tilting the other way. The screen might show $90 an ounce, but dealers are asking half as much again for coins and bars you can pick up now. That gap is not a glitch and not a secret cartel. It is the market saying, we do not fully trust the promise that metal will be available later. At the quoted price, we want metal in hand, and we are willing to pay up. Think of it as walking into a car dealership and finding an empty showroom. The manager tells you that if you wait 6 months, you can order the new SUV for $50,000. Out in the parking lot, the only working SUV in town is changing hands for $80,000. If you need to drive away today because your business or your family depends on it, you do not argue about the brochure price, you pay for the only car that exists. That is what backwardation feels like in practice. Now put the mint into that picture. If the futures curve and the official quotes say 90, but the bulk suppliers who can deliver serious tonnage want 120 to 130, the mint really has 3 paths. It can sell at normal-looking prices and lose money on every coin. It can push retail prices so high that the public and politicians explode, or it can hit pause, blame volatility, and wait for calmer water. The recent decision to suspend products is the 3rd path. It is not a sign of calm. It is a sign that official channels are trapped between a paper price and a physical market that no longer lines up. This is also not the first time a metals market has hit that kind of wall. In the late 1970s, silver drifted for years. Then 2 Texas oilmen, the Hunt brothers, started buying both metal and futures in size. At first, nobody took them seriously. Then the price began to climb. Then it went near vertical. By January 1980, silver briefly touched $50 an ounce. Not because engineers found a new use for it, but because paper claims and physical barrels of metal slammed into each other. The response from the system was blunt. Exchanges raised margin requirements. Trading rules were changed while the game was in progress. Orders were limited to selling only. The squeeze was cut off. The lesson was simple. The system would not allow free price discovery to run to its natural end if that meant breaking major players. In 2011, silver made another run from under 20 to almost 50. Different era, same pattern. Volatility spiked. Smaller traders poured in, and as pressure built, the exchange stepped in again with rapid margin increases. The price was cut in half, and the move was written off as a blow off top. And it is not just silver. In 2022, the nickel market in London broke so violently that the exchange canceled trades after a huge spike, because a large short was about to be wiped out. The pattern repeats. When a highly leveraged metal market runs into hard physical limits, the official response is not to stand back and see where a true clearing price would land. The response is to raise margins, change rules, and steer the story. What is happening in silver now fits that script. As if the ongoing shortage were not enough, January 1st added another layer. On that date, China stopped treating silver as just another export and moved it closer to the category of strategic material. A new export license system came in. Only a set list of approved firms can ship refined silver out. Each shipment needs a government sign-off under rules similar to the ones Beijing uses for rare earths. Analysts estimate that well over half of the world's refined silver flows are touched in some way by Chinese refiners, so putting a license gate in front of that flow matters. It is not a full embargo. Metal can still leave China, but every ton now passes through a political checkpoint, which adds delay and doubt at the exact moment Western vaults are thin. Markets noticed. The surge in silver from the 80s into the $90 region lined up with the expectation and the arrival of those controls. Boiled down, the picture is simple. The shortage drains the vaults, the mint flinches. China tightens the export pipe. These are not random, unrelated headlines. They are parts of one stressed system, trying to keep the lid on a market that no longer has enough metal to comfortably satisfy all the promises that have been written on top of it. Right now, here is all you really need to keep in your head from everything we have just walked through. Silver has run to around $90 an ounce. Gold is pressing into the mid-4,000s. The mint has already stepped back from parts of the market. Big exchange inventories are thinner than they have been in years, and China has put a political gate in front of a huge share of refined silver exports. In the 5-stage pattern we talked about, that means the sovereign signal is flashing and the vault drain is not theory anymore, it is happening. As soon as you say that out loud in polite financial circles, you get the same reply. People say $90 silver cannot last, that at these prices, factories will cut back, clever engineers will find substitutes, scrap will pour in, the shortage will vanish, and the price will roll over. There is a small truth inside that story. High prices can destroy demand and can pull new supply out of hiding. The real questions are how quickly that happens and how big the effect really is. On the industrial side, change is slow. Solar panels, electronics, and electric vehicles use silver because for many of the jobs it does, there is nothing that quite replaces it. Engineers have already spent years trying to thrift and swap it out. They have made progress around the edges, but the big shifts, redesigning whole product lines, retooling factories, and getting everything certified again, take years, not weeks. So yes, $90 silver gives them more reason to push harder, but that does not erase a structural shortage by the next earnings season. Scrap is the other answer people reach for. When the price jumps, more old silverware, jewelry, and industrial leftovers come out of drawers and warehouses. That does help, but only once. Each fork, each candlestick, each obsolete component can be melted down a single time. That is a one-time top-up, not a lasting fix. If new demand and limited mine supply keep pulling more metal out of the system than goes back in. There is also an inflation point most people forget. In the last big spike, around 1980, silver briefly hit $50 an ounce. If you adjust that for what money buys today, you're looking at a price well over $200 in modern terms. By that yardstick, $90 is not some cosmic outlier. Many serious analysts would say that even after this move, silver is still cheap compared with its own history and with gold. So the line that prices this high must crash is less a law of nature, and more a psychological anchor. It feels comforting because it points back to the old range we're used to. The hard data says something different, that the shortage is built in, not a passing quirk. Stage 3 is the paper divorce, the point where owning silver on paper stops lining up with metal in the real world. Most people who say they own silver do not have coins in their hand or bars in a vault with their name on them. They have exchange-traded fund units, unallocated accounts, pooled storage, or futures they plan to roll forever. All of that is really a promise, not metal. It works as long as almost nobody says the dangerous words, "ship me the bars." Put that structure under the pressure we have already walked through, the shortage, the drained vaults, the mint stepping back, the export controls, and there is a clear breaking point. If enough people try to turn those promises into delivery, the system does not have to explode in a dramatic default. History says it morphs into something softer. Settlement rules are tweaked. Cash settlement becomes the practical norm. Delivery times stretch from days to weeks and then to months. We can already see the stress in London where unallocated accounts sit on top of far more paper ounces than there are freely deliverable bars. Public analysis talks about hundreds of millions of ounces owed on paper against only tens of millions clearly available if everyone demanded prompt delivery. If London ever says outright that certain contracts will be paid in cash at the screen price instead of in metal, that is the moment the paper and physical markets officially part ways. Picture being told you'll be paid $90 per ounce in cash in a world where actual coins and bars, if you can even find them, cost $130 or more. The gap is not a rounding error. It is a transfer of wealth from you, the holder of the claim, to a system that cannot deliver what it promised. That is stage 3, and it does not need a default headline. It only needs the rulebook to be used in ways most people never bother to read. Stage 4 is the policy hammer. The way exchanges and regulators try to cool the fever without fixing the illness. When volatility jumps, when politicians start paying attention, when inventories look thin, they reach for the same tools. They raise margin requirements, which forces anyone who is leveraged to post more cash or close positions. They tighten trading rules. This does not create a single new ounce of silver. It does not reopen export flows. It does not undo years of underinvestment in mines. What it does is buy time. It throws out weak hands, drains off some of the speculative froth, and cuts down the number of people who can afford to stand for delivery. From the outside, it looks like a sharp drop in the paper price, reassuring headlines about regulators cooling a bubble and a lot of commentators saying silver was just a trade that went too far. Underneath, the shortage, the emptying vaults, and the export controls are still there. Stage 4 does not end the whammy pattern. It stretches it and shifts the pressure. Stage 5 is the end game, and it really comes in 3 shapes. The first is paper capitulation. In that path, exchanges and clearinghouses lean fully into cash settlement. A growing number of paper products reserve the right, in plain language, to pay you dollars at the official spot price instead of metal. As leverage comes out of the system, the quoted price on the screen can even fall. Physical metal does not suddenly become cheap again. Premiums on real coins and bars stay high or climb because the basic issue, too many promises sitting on too little metal, has not been fixed. In that setting, paper holders become the shock absorbers. They eat the difference between a neat cash payout and the much higher cost of replacing it with physical silver. The second path is the classic short squeeze. The structural shortage runs straight into large short positions and limited inventories. Some of the players who have been betting against silver for years discover they cannot find enough metal at any sensible price to honor their obligations. They have to rush into the market and buy back in at rising levels. That kind of move does not creep, it leaps, and it can carry silver well beyond $100 before it pauses. Mining shares, especially the more volatile smaller producers, are the ones that move the most in that version of events. The third path is the long grind. In that world, the mint returns, but only at much higher prices and with rationed supply. London and New York keep going, but under tighter rules and more fine print. There is no single explosion. Instead, you live through years of stubborn deficits. Out first. Positions are closed, accounts blow up, and they become the cautionary examples. One step above them are the comfortable paper holders who told themselves they owned silver through unallocated accounts, pooled products, or structures that can legally be settled in cash. If the gap between paper and physical opens up, they may be paid at a number that no longer buys the metal they thought they owned. On a statement, it looks fine. In the real world, their purchasing power has quietly leaked away. Higher up are the industrial users. They see the official spot, quote, move. But when they go to secure the tonnage they need, it is not really available at that price. They either pay more or they slow production. And in a squeeze, they are buyers whether they like it or not. Near the top are the people who hold real metal outright, in their own custody or with clear title and no debt attached. They still feel the swings and the opportunity cost, but they are not the shock absorber of last resort. That is the unspoken hierarchy. The system always tries to push losses down toward the people with the weakest claims and the least information. Your job is simple. Know where you stand on that ladder and do not assume the rules are written for your benefit. So what can you actually do with this? First, treat it as education, not as a trade idea. I am not your advisor, and I do not know your situation. What you can use is the way of thinking. Be clear in your own mind whether you are chasing price, which mostly lives in paper products, or whether you want a store value you can actually point to. Pay attention to behavior rather than headlines, how silver reacts when bad news hits, whether physical dealers start talking more about delays and limits, whether the small annoyances around getting real metal slowly become normal. And decide in advance how you will respond when the next violent move comes. The worst time to write a plan is in the middle of a vertical candle. Even if your choice is to stay out or simply sit tight, decide that before the next wave. In a squeeze, freezing counts as a choice, and it is usually the choice the system is counting on. People have one more habit in moments like this. They wait for permission. They wait for the big channels to say, yes, this is now a crisis. They wait for a banker or a favorite commentator to explain what just happened. And by the time that happens, the simple moves are already gone. At this point, you already know silver is stretched. Official sellers have pulled back, export rules have tightened, and serious research is calling this a structural shortage. You do not need one more headline to tell you the system is under strain. What you need is a decision you have made on purpose. That might be learning more about how bullion banking really works, changing how you spread your savings, or deciding you are comfortable staying out of precious metals and living with what that means. Whatever you choose, let it be deliberate, not the result of scrolling past the same warning for the 10th time. So let us tighten the pattern one last time. First, mints and official channels blink, then the big pools of metal are drawn down, then the promises on paper start to drift away from the price of real bars and coins. Then the rules and margins are used to cool the fever without fixing the shortage. Finally, the system chooses who absorbs the loss, whether that is people holding paper claims, savers through inflation, or institutions through forced repricing. If you have stayed with this, you now have a map that most people do not. You know why a missing buy button and a change in Chinese export licenses might matter more to your future than 1,000 points on an index. So the last question is simple. In a world where the price of money itself keeps moving, what do you really trust more? The number on the screen or the rules and plumbing underneath it? Let me know what you are seeing where you live, in premiums, in delays, and policy shifts. Thank you for watching, and please subscribe and like the video. Nothing in this documentary is financial advice. Always do your own research and consult a licensed professional before making financial decisions.